Welcome, this is Ike Hoffman with Tactica Real Estate Solutions, and today we will underwrite a 78-unit distressed multifamily property. Now, this is a two-part video series. This video will focus on qualifying the opportunity with a few basic inputs. We don't want to sink a ton of time into it at this juncture. We have the rents, some expense assumptions, some CAPEX, high-level stuff. We just want to make sure that it's worth sinking more time into and looking at it more in depth. Part two, on the other hand, that covers the gambit of pro forma underwriting. We'll look at the deal data, so the rent roll, the profit and loss statements, property tax statements. We'll input that all into Tactica's redevelopment model. We'll make a detailed renovation plan, and then we'll reassess the project's upside at that point in time. In this video series, I feature two Tactica pro forma tools. In this video, it's the back of the envelope multifamily analysis template. It's free. If you need a tool to quickly vet your deals, you can download that below. In video 2, we're going to be using Tactica's paid redevelopment model. If you've been enjoying these underwriting tutorials, I'd really appreciate it if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. Let's dive in. We're looking at the analysis tab of Tactica's free envelope multifamily template. It's a simple one-pager. The idea is we can put in some high-level assumptions, and hopefully that will help us justify whether it's worth sinking more time in and doing a more extensive analysis later on. So let's start in the general property information section. The property we're looking at, it's 78 units, and there's approximately 72,000 rentable square feet. And then we can slide over to the left in the pricing, debt, and equity section, and we need to put in the price assumption. So we'll say we're talking to the owner directly, and $6.5 million is the amount that's being volleyed around at this point in time. Now, this property is distressed. It's about 50% occupied. There's a significant percentage of these tenants aren't paying rent, so there's a lot of bad debt in the historical financials, and there's a ton of deferred capital, meaning we're going to have to sink a lot of money into this property to salvage it. Due to the soft rent roll and weak operating historicals, we're not going to qualify for traditional agency financing like a Freddie or Fannie loan. We'll need to go the bridge route. So I'm going to type in bridge as the loan type. And then you can see there's a drop down here whether we want LTV or LTC. Ideally, if we go the bridge loan route, not only will we get financing for the purchase price, the $6.5 million purchase price, but also the capital as well that we're going to need to spend to improve this property. So I'm going to click LTC here, and we will hope for, just in this environment, it's hard to get a lot of leverage, so we're going to hope for a 60% LTC loan, and we'll use 9.25% as the interest rate placeholder for now. Now the amortization, it's currently 0, and I'm going to leave that as 0. That's a little weird, and the reason is this model isn't really set up for bridge financing, to be perfectly candid with you. It's for stabilized deals. We're going to need to make a minor alteration to this to account for the interest-only bridge financing. This loan won't amortize like a traditional agency loan would, so we can just come down to the annual payment. In its baseline state, there's a payment formula. We're going to delete that. We'll just hit equals, and then we'll take the loan amount times the interest rate, which is the interest-only payment. And we'll come back up to the loan cost then. We'll just say that this particular lender would charge as a fee 1.5% of the total loan amount. Now we need to come over to the CAPEX section. I don't want to do a sophisticated breakdown on how we'd be spending this capital, like on things like on roofs, on HVAC, on the interior units, on common areas. We'll get to that in part 2 of the video series, but for now, I'm just going to make a ballpark estimate. We'll say that this property needs about $40,000 per unit, so 40,000 times 78, which is 3.1 million approximately. And then again, because we're using that LTC loan assumption to the left, we would get 60% of the purchase price, 6.5 million, plus this additional 3 million. So our loan proceeds are going to jump up significantly to 5.77 million. And then we can come down to the property tax section. It's easy to find property tax information online. We'll say the current assessment is 10.34 million, and that the tax is payable this year is $189,000. And then the reassessment is a percentage of purchase price. We're just going to put in 100% for now. If you notice, we'd be paying significantly less, the 6.5 million, than what the property is assessed at. So ideally, property taxes would decrease. But for the sake of time savings, I'm going to back into an expense ratio. So it doesn't really matter where the expenses are coming from, whether it's property taxes, payroll, repairs and maintenance. whatever. I'm going to just be solving for a 45% expense ratio. And then we'll vet this much further with actual property tax comps later on and looking at some of these operating line items as well and see like where we can cut or where we're going to need to maybe bolster certain expense line items and spend a little bit more money. Now let's come over to the operations section. I know that the rent at the property, the average in-place leased rent is $1,120. I took a quick glimpse at some rent comps, and pretty much every comp was 30 to 40% higher than where this property is at. And now it's going to take quite a bit of investment to fix the property and shine up the common areas and make these units nice and make them comparable, truly comparable to what's in the comp set. But properties that were built in the same era with just vastly superior management are achieving quite a significant premium. So for now, I'm just going to kind of take the middle ground of that 30-40%, and I'll take our rent and I'll say the premium is 35% of that. So we have a premium of $392. And then I'll put in some ballpark estimates for our other income items. There are detached garages. I think $45 per month is a reasonable charge there. For other income, I'll just do $50, and then we'll run a 5% vacancy for now. On the expense side, I'm not going to put a ton of thought into all these individual line items. I'll use Excel's goal seek function, and we want to set the expense ratio to 45% by changing, and we'll just use the admin line to save time. So once we've completed that, we have a functioning pro forma. The final thing I want to mention about the operations is the debt service coverage ratio. It's not completely relevant, right? Because we have our bridge financing assumption entered into the price, debt, and equity section of the model. And ideally, when we get to this point where we have stabilized operations, we're getting this $392 premium, and we're hopefully achieving a 45% expense ratio, we'd blow out that bridge loan and we'd put on like a Fannie or Freddie loan that has a term of 10 years, and that debt service coverage ratio would look entirely different than it looks now. I'm not paying a ton of attention to it. The real value comes in the return metrics section. So the last input we need to make is what the historical cap rate is. 2 years ago, properties of this caliber were selling for high 4 caps, low 5 caps. Now, probably closer to a 6.25 cap. There have been just a handful of sales that have been kind of 6 to 6.5. We'll take kind of the middle ground there and say 6.25. And now our model's complete. As I talked about earlier with the debt service coverage ratio not really being relevant in this particular instance, the cash on cash return isn't as well. When it comes to having these stabilized operations, we're going to have entirely different debt. So we can really throw it out at this point and ignore it. What I'm really focused on is the yield on cost. So the yield on cost takes our pro forma NOI, which is $788,000, and it divides it by our total cost basis, which is right above this green box here. Our total cost basis is the price, the CAPEX plus the loan cost. There's a nice spread here between the yield on cost and the cap rate we could potentially sell this for once we fix up the property and stabilize it. The larger the spread between the yield on cost and the cap rate that this deal would likely sell for in the marketplace, the more profit potential there is. From strictly a dollars standpoint, that profit potential is just shy of $3 million. So it's clear that if we can execute this redevelopment business plan, it could be wildly successful. The issue is at this point in time, there is a lot of logistics and execution that need to take place between purchasing the property and achieving these stabilized operations we show in the pro forma. And we need to create a more granular underwriting that really shows the details of the renovations and the CAPEX plan and just the improvement of the property operations. And Tactica's redevelopment model is the perfect tool for that. In summary, we have a 78-unit distressed multifamily building that justifies a more thorough analysis. There's a nice spread between the yield on cost and the market cap rate, which essentially would be the investor's upside. Now it's time to study the rent roll, the rent comps, the renovations plan, and fine-tune the underwriting assumptions. We'll cover all of that in video 2. That's linked below in the description, and I'll see you there. If you've been enjoying Tactica's real estate tutorial content, I'd really appreciate it if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. Thanks for tagging along.